We're now going to, if I can find my book, we're going to look at exercise 2-5. Now, exercise 2-5 is really focusing on one particular account, retained earnings. At the beginning of April, Owl Corporation has a balance of $13,000 in the retained earnings account. During the month of April, Owl had the following external transactions. We're required to, using these external transactions, compute the balance of retained earnings at April 30th. So I'm going to create an account for good old Owl. I'm going to call it Retained Earnings. And we're going to start with a beginning balance of $13,000, was it? Okay. So, the first transaction, wish I could get this stuff off of here. No, I didn't want it. I want to get this thing off. You know, this is the stuff that's frustrating. Okay, I'll quit. Anyway, it's not. That green arrow will take me to the previous page.
Do you have a mouse wheel? Do you have a plus symbol on your computer?
Yep.
Hover over the right section, and then hold over like where all the text is.
Uh-huh.
And then hold Control and hit the plus symbol. No? Oh, I was hoping that it would zoom in.
Yeah, it's making this bigger, but no. This is kind of new in this, to have this side thing. I got to figure out a way to get rid of it because it's taking up valuable space for you guys. Okay, yeah, because the plus symbol generally makes the text bigger. Do you know what I mean? Or I'm probably making it smaller. Oh, making that bigger.
Oh, what the heck?
Ah!
Sorry.
Undo.
Oh, look!
Hey, there we go.
I'm making...
There we go.
Thank you! You made it... I did minus, and it made that smaller. Oh, my gosh! You're a brain!
Yeah, Boston was helpfully useful.
Okay, 2-5. Oh, thank you. You might have to remind me next week, though. So, E25. Let's evaluate this first transaction. Issue common stock for cash, $11,000. Think of what transactions are involved, guys. What happens to cash? Cash goes up and common stock goes up. But the question is, does it affect retained earnings? Stockholders' equity is a result of common stock and retained earnings. So it would not affect retained earnings. It affects common stock, but not retained earnings. Next, number 2, provides services to customers on account. What accounts are affected here? Cash? No. Accounts receivable goes up. What else goes up? And what kind of stockholders' equity goes up? Retained earnings increases when we receive revenues. So this showed an increase of how much? 8,500? Okay. Next. Provide services to customers in exchange for cash, 3,200. Cash goes up, and what else goes up? Retained earnings goes up by 3,200. Okay. Next, purchase equipment and pay cash. Think of this through. What goes up here?
Equipment goes up.
Equipment, which is an asset, goes up. Cash goes down, and what is cash? Does it affect retained earnings at all? No. Next, pay rent for April, $1,100. Cash goes down, and retained earnings also goes down, doesn't it? Because we're using up retained earnings, right, to pay a cost. Next. Pay employee salaries for April, $3,500. What happens? Cash decreases and retained earnings also decreases. 3,500, is it? Okay. Number 7, pay dividends to stockholders, $2,000. Cash decreases, but our retained earnings decreases $2,000. So, what would our ending balance be here? Ending balance, retained earnings. Do you guys have that? So what this exercise is trying to teach us is which of these transactions ultimately affect retained earnings. Okay? Now we're going to move back to the slide, and we're now going to talk about a concept, debits and credits. Now, debits assess whether the impact of external transactions result in a debit or a credit to an account balance. The most important thing, one of the most important things you learned tonight, is a debit means left, and a credit means, so a debit means, a credit means,
Right.
a credit means,
Right.
a debit means,
Left.
don't forget that, okay? So, when you debit something, it only means you put it on the left side. When you credit something, it only means you put it on the right-hand side. That is it. Debit means, credit means.
Right.
Now, let's think of this accounting equation. Do you remember the accounting equation? I better put it on the slide since, well, you guys see that. The accounting equation, assets equal liabilities plus our stockholders' equity. Assets are on the what side of the equation?
Debit.
They're on the left. Therefore, a normal asset balance is a debit. Because debit means left. But what side of the equation is this on?
Right.
So, when a liability or a stockholder's equity increases, a normal balance for these accounts will be always a credit, because the normal balance will always be on the right-hand side of the T account. Okay? Hang in there with me. So, assets. A normal balance of an asset is on the left-hand side, right? Which is a debit. The normal balance for liabilities and stockholders' equity is a credit, which means on the right-hand side. So for assets, assets increase with debits. On the right-hand side, liabilities and stockholders' equity increase with credits. Okay? However, when we want to decrease an asset, what are we going to do with it? Credit it. When we want to decrease a liability or a stockholder's equity account, we'll debit it. Because again, the normal balance for assets is a debit, which means what makes it increase? We debit it to make it increase. To make a liability or a stockholder's equity account increase, we credit it. Again, the opposite is true to decrease the balance of any of these accounts. So here is a really important slide I want you to look at during the week. It's on. I have the PowerPoint in the content section, and you can also look at this. So we know assets have a normal debit balance, which means to increase assets, we debit them. Liabilities and stockholders' equity have a normal credit balance, which means to increase them, we credit them. Stockholders' equity is made up of common stock and retained earnings. To increase common stock or to increase retained earnings, we credit it. To decrease common stock or decrease retained earnings, we're going to debit it. Now, if we break it down a little farther, we know the income statement, which are revenues minus expenses. Revenues increase our retained earnings, don't they? So when we add revenues, we increase our retained earnings. Therefore, the normal balance of retained earnings is a credit balance. But we also know expenses and dividends do what to our retained earnings count? They decrease it. So since they decrease it, we debit it when they decrease it. So we know expenses and dividends then have normal debit balances. So here's a way you can remember this. Debit and credit effects of each of the account types. Dealer, D-E-A-L-O-R. Dividends, expenses, and assets have all normal debit balances, and to decrease it, we credit. But the LOR, liabilities, owner's equity, and revenue, have normal credit balances, which means to increase liabilities, owner's equity, and revenue, we credit it. To decrease liabilities, owner's equity, or revenue, we debit it. Give yourself a cheat sheet until it starts making sense. So you can, and then also remember the accounting equation. Assets always have a debit balance because it's on the left-hand side of the equation. Liabilities and stockholders' equity always have a credit balance because they're over here on the other side of the equation. So, if you get this one wrong, you're in trouble. What does the word debit mean? Who said right? Oh, good. Everyone said left. I held my ears. I was scared you were going to say it wrong. What does the word debit mean?
Left side.
Awesome. Okay. The word debit means left. The word credit means right. Bottom line. Do you guys know how many of you guys have gone to your bank and you put money in the bank into your account and the bank teller says we credited your account? How many have heard that before? So oftentimes you think credit means increase. Okay? They're right. When you go and you put money into the bank, their bank, your money is a liability to them. Because don't they owe it back to you? So do you understand why now they say to you, we credited your account? For the bank's eyes, they debited cash, which increased their cash, but they had to credit your balance, which is a liability, because that's increasing what they owe back to you. Make sense? Now we're going to talk about recording transactions in a journal using debits and credits. A journal provides us with a chronological record of all. You know what, guys? Can I wait a minute? I want to do number 2.6. Let's do 2.6 real quick. Okay? Sorry. 2.6. Below is a list of common accounts. We need to say if the normal balance is a debit or a credit. Okay, indicate whether the normal balance of each account is a debit or a credit. So we have cash, debit, service revenue, credit, salaries expense, accounts payable, equipment, retained earnings, credit, retained earnings, utilities expense, debit, because it decreases our retained earnings, and to decrease retained earnings, you debit it, right? So expenses have a normal debit balance. Accounts receivable, debit. Dividends, debit. Common stock, credit. No, guys, go over this and over it and over it. Okay? Again and again and again.
Salary expenses are credits, right?
Nope. Salary expense are debits. DEALOR. Dividends, expenses, and assets have debit balances. Liabilities, owner's equity, and revenues have credit balances. Okay? Let's look at 2.7. Below are several external transactions. Is this okay we're doing all these problems? I think it's the best way to learn, guys. I really do. So below are several external transactions for Hoki's company. Okay? Hoki uses the following accounts. Guess what all these accounts are called for Hoki? The grouping is called their chart of accounts. Got it? Indicate which accounts should be debited and which should be credited. So let's just look at the first one. Pay a cash dividend. Think about it a minute, guys. When you pay a cash dividend, what goes up? Or let me stop by saying, what accounts are affected? Cash and retained earnings. But look at what accounts they want us to use now. Hoki uses the following accounts. They have cash, that's good. So when we pay a dividend, we know cash is affected here, and what other account is going to get affected when we pay a cash dividend? Rocket. You see? Dividends. Okay? Sometimes I emphasize the word like, cash dividend. So, what two accounts are affected? Cash and dividends. What happens to cash when we pay a dividend? It goes down. What is the normal balance of cash, which is an asset? It's a debit balance. So what do we do to reduce cash? We credit it. So for number one, to pay a cash dividend, we credit cash, which means what's the normal balance of dividend accounts? It's a debit. When we increase dividends, we debit them. Many times, guys, I'm kind of going to give you a cheat thought. Even still, when I'm working through a transaction, I always think of what's happening to cash, to just help me process through. What's happening to cash? Then if cash is being credited or decreased, then usually I know the other side's what's going to be debited. Get what I'm saying?
So debited would be the dividend?
Well, whatever the account is. So in this case, if cash is being credited because it's decreasing, our dividend is a debit, which means that the dividend is being increased, which it means the dividend has a normal debit balance. Number two, look at that and take some time just to think what accounts are being affected. Cash. Who is saying prepaid rent? The reason I know it's prepaid rent, pay rent in advance. If it said paid rent for the current month, it's a rent expense. If we're paying rent in advance, what are we doing? We're going to receive a future benefit. So pay rent in advance, we know the two accounts, cash and prepaid rent. They're both assets, aren't they? What is the normal balance of an asset? A debit. So which of those will be debited? Prepaid rent will be debited and which is credited? Because cash is going down, prepaid rent is increasing, right? Number 3, provide services to customers on account. On account. Accounts receivable, and what else? Service revenue. What is accounts receivable? An asset. What is the normal balance of an asset? A debit. So when we provide services to customers on account, what's happening to our accounts receivable? It's debited. It's increasing, isn't it? The other side is service revenue. When we provide services, that means our revenue account is increasing, right? What's the normal balance of a revenue account? Credit. And we also know it's a credit because it helps increase our retained earnings, right? And that's always a credit balance. So, to provide services to customers on account, accounts receivable is debited, service revenue is credited. Does that make sense, guys? Are we doing well? Number 4, purchase office supplies on account. Take 10 seconds and just write down what you think it's going to be. Okay? What do you think it's going to be? Also look at 5. Write down what you think it's going to be. Okay? So guys, if we purchase office supplies on account, we're going to use at least 2 accounts to handle this transaction. What 2 accounts would we be using here? Supplies, accounts payable. Remember, a receivable is when people owe us money. Payable is when we owe people money. Okay? So when we purchase office supplies on account, what's going to get debited here? Supplies. What's going to get credited? Accounts payable. Why? Accounts payable has a normal what balance? Credit balance. Remember, assets have a normal. Liabilities and stockholders' equity have a normal. You're not going to forget. You see why I keep doing this? You'll get tired of it. But it cements debit, credit, debit, credit. The equation, when you look at it, assets are on what side? And what's their normal balance?
Debit.
Liabilities and stockholders' equity is on what side of the equation?
Right.
And what is their normal balance?
Credit.
Because credit means?
Right.
And debit means?
Yes.
Get it? Okay, I'm sorry.
No, I think you need to do it one more time.
I'm going to be doing it in my sleep tonight. Okay. I promise you will see it one more time. Okay. Where are we? Number 5?
Yeah.
Pay salaries for the month. What 2 accounts are being used? Cash. Salaries expense. If it said pay salaries on account, or we owe salaries to the client, to the employees, Then what would it be? Salaries payable and salaries expense. But since it says we paid salaries for the current month, it's salaries expense and cash. Right? What happens? What's being debited? What's being credited? Why is cash being credited? It's going down. We're using it up. Number 6. Issue common stock in exchange for cash. Cash. Cash goes what? Debited. Common stock. Because common stock has a normal what account?
Credit.
Collect cash from customers for services provided in 3 above. So in number 3, let's think of what we said. Accounts receivable was debited and service revenue was credited. Now in number 7, we're getting some money. So what 2 accounts are being affected? Cash and accounts receivable. We showed the services back in number 3. So we already showed the service revenue. Now we want to get our money. Now that they're paying us our money, what gets debited? What gets credited? Accounts receivable. And accounts receivable gets credited. Think about it. They owed us money. Once they pay us the cash, they don't owe us that anymore, do they? So we reduce that accounts receivable. Next, borrow cash from the bank and sign a note.
Notes payable.
Notes payable. What is debited?
No. Notes payable.
What is debited? Cash. What is credited? What increases? And notes payable has a normal credit balance, so when it increases, we credit it. Does that make sense? Number 9, pay for the current month's utilities. The utilities expense and cash. What gets debited? What gets credited? Number 10, pay for office supplies purchased in number 4 above. Accounts payable and cash. What gets debited? What gets credited? Awesome, guys. Guys, this can be tricky. But if you stay focused on debit and credit, and you stay focused on this accounting equation, the left side of the accounting equation has a normal debit balance, which means left. The right side has a normal credit balance, which means right. If you remember that, and you just look at it and process it through, you're going to be fine. Okay, back to the PowerPoint. So now, we are going to talk about how we go about recording these journal entries. So by recording transactions, we use a journal. This journal provides a chronological record of all the transactions. And we use what's called a journal entry, which is the format used for recording transactions. So, do you see that the debit amount over here will always equal the credit amount? Okay? So when you were asking me earlier what was I doing, I was just kind of preparing you for this next area without you knowing it. On December 1st, Eagle Golf Academy sells shares of common stock to investors for cash of $25,000. So cash increases, common stock increases. So our journal entry will show a debit to cash. Do you see this is the account? We know it's an asset. It's increasing, so we debit it. Common stock is a stockholder's equity account. We know we're increasing it, so we credit it. This is what we call a journal entry. We always record the debit side first, and then we indent to record the credit side. Okay? This journal entry just shows this transaction of selling shares of common stock to investors for cash. Guys, we've talked about this. You guys know assets increase, stockholders' equity increases, don't we? We're still saying the same thing, but guess what we've learned now? We've learned what asset is it? What type of stockholders' equity is it? Haven't we? So we've gotten that far. Now we're taking it one step farther. We know assets, when they increase, they have a normal what balance? And look what we're doing right here. We're putting it as a debit. And when common stock increases, it has a normal. So we're taking what you've gained in understanding these transactions. We're just adding to it. And now we're creating a journal that is describing on paper what we've been saying. Does that make sense? Where's everyone at? Yes.
So I'm wondering if I can think about it as we're losing stocks because we sold them, so that's why it's credited.
No, we're not losing stock. We're increasing our stockholders' equity.
So wouldn't it be debited?
So let's go back. It's okay. I'm glad you're asking, okay? But this is what's important about a classroom, because if you're thinking it or have the guts to say it, how many other people are thinking it? Get it? And so this is important, guys. Every transaction has at least 2 accounts that are affected. So when Eagle sells shares of stock, what are they trying to do? They're getting owners. So they're creating owners for the company. An owner in the company is part of stockholders' equity, right? When stockholders' equity, when we gain more stockholders, what happens with stockholders' equity? It increases. So when we sell shares of stock, what do we get when we sell shares of stock?
Okay.
Cash. What happens to cash? It goes up, and cash is an asset. Remember, there's 2 sides to every accounting. Cash goes up. But cash goes up because we got new investors, our owners. And what else is going to go up? Stockholders' equity is going up because we have owners that have invested in the company. They've given us cash, but again, we're not a single entry system. Everything we do has two sides to it. So our cash increases and our shareholders or our stockholders' equity also goes up. Does that make sense?
I think I hear what you're saying though, because you're hearing what I believe you're hearing is that the stocks are already inside the equation. So when we sell them, they should go somewhere else. Like they should decrease, but like the stocks aren't in the equation yet. They're being sold like outside of the equation, and once that happens, how does that sale affect the company? Right.
Because we are a new company and we're starting out. So we're trying to get investors in the company. So we're issuing shares. So I see what you're saying as though something's already happened in here. Well, this company's just begun. Okay? And just so you know, without confusing you, this is for the initial sale of shares. Once the company initially sells shares, unless they issue more shares, the company doesn't benefit from this anymore. Once a company goes public, shares are sold to other public people. They're not sold back to the company unless the company buys what's called treasury stock, we'll talk about down the road. So when you hear about Apple gaining all this money, those are investors that are making money, the owners of a company. Okay? So, in this example, when Eagle sells shares of common stock to investors because they're trying to get investors in the company, owners. By trying to get owners in the company, cash increases and common stock also increases. So cash gets debited, common stock gets credited. Many students forget to indent the credit account names. For the account credited, be sure to indent both the account name and the amount. So basically, I don't know if I want to go this far. Let me look at your homework and see what, because what I don't want to do is go farther than guys, this is why I've allowed Chapter 2 and Chapter 3 to last 2 weeks each. It's a lot to cover. And the hard part is to absorb it. And that absorption takes time to process. And you just can't do it in one setting. So let's look here. I just don't want to go too fast for you, for what I've scheduled. Chapter 2, homework week 1. Let's look at this, okay? Okay. That's similar to what we've been doing. Increase, decrease, liabilities. This is when, for example, how does it affect the liabilities or the assets? If we pay $310 for current month's rent, what happens to assets? They go down $310, don't they? What happens over here? Stockholders' equity will go down $310. See what I'm doing? When we hire a new employee who will be paid $640 at the end of each month, nothing. Paid advertising for $120 aired in the current period. Our asset goes down, cash. Our stockholders' equity goes down. Let me see if I have to say nothing. No, I don't think. Maybe I have to put zeros. Okay. It's the only thing I don't care about this connect is sometimes you don't know what you got wrong because you didn't put a zero. When you purchase office supplies for $310 cash, what's going up? What's going down? Which is? So ultimately, nothing changes, right? Right? So you guys get what's happening there. Okay, next.
Is that what we do for that one? Because there's an extra line.
What do you mean? Okay, purchase office supplies, so okay. So then what we have to do here is show 310 is a positive and then 310 is a negative. Damn. Okay, so then you get what I'm saying. So receive cash from customers and one above. So cash goes up 1410. Accounts receivable then goes down. Get it? Okay. Next. Guys, here you have to list each account. You need to say what kind of account it is and whether the normal balance is a debit or credit. Whenever something has a payable, what kind of account is it? Liability. It's a liability account. So the type of account, is it an asset, a dividend, an expense, a liability, or a revenue or stockholders' equity? What is salaries payable? Does a liability have a normal debit or credit? Credit? See what you do here? Common stock. What kind of account is it? Stockholders' equity. Is that a normal debit or credit? You guys think you can handle this? What I'm trying to help you see, and I don't know if this is helpful for you, because you know what? I didn't see as many hundreds in homework as I thought I would in this class. Just saying. Yes?
In case I forget, like, what type of account that is, where, do you know what page of the book it kind of like lists that, or something like that?
So we are in chapter 2. And in chapter 2, it tells us about assets. It's not really giving us a list of various types of accounts yet, although if you look at page 60, you see assets can be cash or prepaid rent or equipment.
Page 71 is a pretty good one, too.
Which we're just starting to get here. 71 under the chart of accounts, illustration 2.9, gives you some ideas of various types of accounts for chart of accounts. Okay? The key here is we're starting to identify various types of accounts and learning. If you go into those brief exercises, I think the solutions are also at the end of the chapter that help you identify various accounts. But what we're trying to do now is help you start comprehending through going through a series of transactions to identify how we measure based on the account and what account would fit a certain transaction. So we've talked a little bit about cash. We've talked a little bit about accounts receivable. We've talked a little bit about supplies. But you're right, we don't really just have a grouping of accounts and saying these are assets, accounts. So what I'm going to do, I believe I've opened up in your discussion a Chapter 2 homework discussion for you guys. If you look in I believe I have. I did one class. I thought it was this one. But if you go to your class, in discussions, communications, discussions. Do you see how the first sentence says homework, chapter, questions? Chapter 2, homework and questions. This is the hangout place. Somewhere I wrote, this is the hangout place to ask questions. So that is a great thing to start, because you're right, we're starting to explore those, but I really don't see something categorized. Assets equal liabilities plus stockholders' equity. So assets, some accounts that are assets, cash, accounts receivable, prepaids, prepaid insurance or prepaid rent. What else? Supplies, building, land, equipment, receivables. Okay? Then liabilities. Blank payable and deferred revenues. Stockholders' equity, common stock, and retained earnings. Did I break it?
Broke it.
I'm too busy talking. Retained earnings. Revenues, something, revenue. Expenses, okay? And then what I can do is hopefully by doing that, you guys will start asking questions and we can engage. Okay? And that is, like, just your comment was such a good one because, I didn't even think about it. But those are ways we can all come together and, the book is good, but there's better ways to learn. Okay? I was working on homework before that, wasn't I?
Yep.
Oh, here it is. Okay, so do you guys see how going through this will help you kind of cement what type of account, and then this helps remind you, is it a debit or a credit account? Next, for the next one, record the transaction. Okay, so I want to keep We've done some, but basically what we're doing here is we're talking about various accounts, and then as a result, what we're going to debit and what we're going to credit. So Jake provides lawn services to Luke's repair shop on account. What happens here? When it's on account, what does that mean?
Receivable.
Is this for Jake's business or is it for Luke's business? Because I got confused.
Record the transactions for Jake. Then there's another one I think that you have to record it for Luke. But this is Jakey. Jake provides lawn services to Luke's repair shop. What do we do for Jake? Jake is due money, receiving money. So accounts receivable for how much? $310. And what's the other side of the equation? No, it should be revenue. What's deferred revenue? Is this a liability or did we get money? Jake provides services to Luke's repair shop on account. So Jake is providing a service and we are recording transactions for Jake. So if Jake is providing a service, it's a revenue. So where's the revenue?
Deferred revenue.
That's a liability. Service revenue. So remember, if Jake is getting, he is doing some work to get revenue, then the revenue is income, right? If it's on account, that means we didn't receive the cash. It's accounts payable here, right? Number 2, see, you click over here. One of Jake's mowers malfunctions. Luke provides repair services to Jake on account. Guys, we're Jake. Okay? What happens? Someone did a repair for him, didn't they? Accounts payable gets what? Debited or credited? Credited. What's the debit? Is there a repair expense in here?
So really we're doing both viewpoints?
Not here. This one we're focusing on Jake. Okay?
Probably repairs and maintenance expense.
There. And that's for how much? $260? And this would be an accounts payable. Right? $260. So you guys see what I'm trying to do? You go to each one of these and click it to understand the concept, okay? Number 5. I just want to make sure I'm... Okay, now this is where it gets confusing. Guys, do you see how we now have to think of Luke? Now the concept of doing this is to put yourself in the other position, okay? And record from Luke's perspective. Got it? Then number 6. Oh, I guess we only have 5. Okay? Oh.
It's all on the same sheet.
Here. So maybe I do need to do a little more. I just don't want to posting. No, I really don't. The journal, I'm not we've done enough. So basically, this is basically having you do what we've done before, is show Jake's piece, show Luke's repair shop, and see how they differ. Okay? Guys, I don't want to add any more to our plate. We've covered the first 4 learning objectives. I think we want to stop here. Let me see if there are any more problems we can do that would help. Exercise 2.8. Exercise 2.8. Let's just see a minute. Let's do a couple more, guys, if you're game. Exercise 2-8.
Well, we have 2.9 on our pamphlet.
Okay, well, why don't you, like, maybe in the back, let's do 2.8. Okay?
Oh, there's 2.8. Okay.
Terrapin Company engages in the following external transactions for November. Number 1, purchase equipment in exchange for cash of $23,400. We're going to record the transactions. Do you see it tells us Terrapin uses the following accounts: cash, supplies, equipment, accounts payable, service revenue, rent expense, and salaries expense. And that's it. So this particular transaction, purchase equipment in exchange for cash of $23,400, what are we going to do here? What 2 accounts are we going to use? Equipment and cash. What do we debit? What do we credit? We debit what? We debit equipment. We credit cash. Right? So, I'm going to go back here to show you. We will show a debit to equipment for $23,400. Okay? And then we credit cash for $23,400. Does that make sense? Yes? Next, provide services to customers and receive cash of $6,800.
Cash would be debited. Service.
Revenue would be credited, right? So we would debit cash of $6,800 and we would credit service revenue for $6,800. Cash has a normal debit balance. Revenue accounts have a normal credit balance. Okay? Another thing, remember, DEALOR. So, DEALOR, we would dividends, expenses, assets have a normal debit balance. And on the credit liabilities, owner's equity, and revenues have a normal credit balance. That's just helpful for you kind of to remember. I like those kind of little games. Next, pay the current month's rent of $1,300.
Cash, credit, utilities, expense.
And what? Rent expense. So we will debit rent expense of how much? $1,300. We credit cash of $1,300. Do you see how the first one I always put will be the debit account, and the second one I put will always be the credit account, and I indent that account? Okay? Why?
To note that it's the credit.
It's, yes, but it's, you know what is interesting? It's just the standard for preparing journal entries we've always used. Next, purchase office supplies on account for $1,000.
Supplies get debited. And accounts payable is credit.
Supplies gets debited for $1,000, and accounts payable gets credited for $1,000. Okay? Next, pay employees' salaries of $2,100 for the current month.
Salary, cash gets credited. Salaries, expense gets credited.
Salaries expense $2,100. Cash gets credited because cash is doing what? Being reduced. Therefore, we credit it. How are you guys doing? Example, exercise 2.9. Below are recorded transactions of Yellow Jacket Corporation for August. Provide an explanation for each transaction. So, who wants to take the first one? Good.
Pay cash for equipment.
Perfect. So a debit to equipment and a credit to cash means we purchased equipment of $8,800 for cash. Awesome. Next, who wants to take number 2? Good.
You're doing service that you haven't been paid for.
Correct. We provided services on account, right? We did the work, but we haven't received the money yet, but we can bill for it because we have provided the service. Okay? Yes. Do you guys agree with that? Number 3.
Sorry.
No, don't worry. I'm so glad you're enthusiastic. Number 3.
Paid cash for current month salaries.
Paid cash for current month's salaries. Perfect. Number 4. A little trickier. Cash and deferred revenue. What happened? And why would we do this? Correct? Correct. We've not performed the service yet, but they gave us the money in advance. Perfect. That's what I'm trying to get at is why. Okay? Perfect. Number 5. Who wants to take that? You guys are rocking it.
Paid $900 dividends to the stockholders.
paid $900 in dividends to stockholders. Awesome. Does this make sense, guys? Is this okay? We just keep do it, and then I will have this in the lecture. If you're stuck again, guess what you can do? Go back and look at it again. Okay? Let's do 210. If those of you who want to leave, don't feel like I'm going to mark you not here, okay? Because it's getting to be a long night. But those of you who want to stay, let's just do a couple more, okay? Ready? 210. Sun Devil Hair Design has the following transactions during the month of February. February 2nd. Pay $700 for radio advertising for February. Remember, look at the accounts we can use.
Cash is credited.
So, cash, advertising, expense is debited for $700, and cash is credited for $700. Next, purchase beauty supplies of $1,300 on account.
Supplies is debited. And accounts payable is credited.
Perfect. Got it? Does that make sense? Next. Who wants to take February 14th? Read it.
Provide beauty services for cash. So cash is debited.
Cash is debited, paid. Provide beauty services of $2,900 to customers and receive cash. So cash is debited.
Revenue services is credited.
Service revenue
Service revenue, sorry.
is credited $2,900. Okay. Next.
Salary expense debited and cash credited.
So pay employee salaries expense for the current month, $900. Salaries expense debited, cash credited. Next, provide beauty services of $1,000 to customers on account.
So one account receivable is debited. And
Service revenue gets credited. Okay, and then the last one, pay utility bill for the current month, $300.
credited and utility expenses debited.
Got it?
Just to rehash this, when you're talking about on account, is that accounts receivable?
Either. When we provided revenues on account, that means we did the work, so we want the receivable. When we purchase supplies on account, that means we owe accounts payable. So on account could mean either one. It just means we haven't received the cash or we haven't paid the cash yet. Okay, guys? I think what we'll do is I might, in the discussions, just kind of, in where that homework is, kind of, say, hey, guys, let's work on E211 and 212 and just kind of get the conversation going to help you. Okay? How are we doing?